The market dropped 3% last week. You checked your portfolio, you saw the number. Maybe you panicked a little. Maybe you stayed calm. Maybe you checked the news to understand what happened. And the news told you interest rates, geopolitical tensions, earnings concerns, inflation data, tech sector rotation, Fed policy uncertainty, all of it real. All of it potentially relevant. All of it also completely missing the actual thing that just happened. Because beneath the headline movements and the news cycles and the fundamental stories that analysts build to explain price changes, something else is occurring in markets that almost nobody talks about and almost nobody sees. Something structural. Something that operates independent of whether the news is good or bad. Something that explains a lot more about why markets move the way they do than the narratives that dominate financial media. Today, we're going to talk about what actually just happened to the stock market, not the news story, but the market structure story that exists underneath it. The one that changes how you should think about volatility, about opportunity, about what's really driving prices when prices move. Why news doesn't explain markets. Here's the first thing to understand. We're addicted to explanations. When something moves, we need to know why. Our brains demand a story, a cause and effect, a reason. The market went down today. Why? The news provides an answer. Interest rates rose, earnings disappointed, unemployment came in higher. There's a war somewhere. The Fed made a hawkish statement. We take the answer and we file it away. We tell other people. We use it to make decisions about whether to buy or sell. We build confidence around the explanation, as if understanding the cause has told us something reliable about the direction. Except here's what the data actually shows. The news does not reliably predict market direction in any time frame that's useful for decision-making. Major market declines have happened with no obvious bad news. Major market rallies have happened despite terrible headlines. The worst days for the market often come when the news is ambiguous or even good, which shouldn't happen if the news is actually causing the moves. The reason this happens is that the news is not primary, it's secondary. It's the story we tell after the price has moved, not the thing that caused the move. This is called narrative fallacy. The human tendency to construct a story around an observed outcome and to mistake the story for the cause. The market moved, we observed it. We constructed a narrative to explain why. We now believe the narrative caused the move. But the narrative is often post hoc rationalization rather than actual causation. The real thing happening, repositioning. So if news doesn't cause market moves, what does? Repositioning. On any given day, trillions of dollars worth of assets are held by institutions, funds, individuals, automated systems. Those positions are not static. They're constantly being adjusted based on 1,000 different variables: rebalancing, performance evaluation, risk management, profit-taking, new money flowing in, withdrawals flowing out, algorithm executions, macro views shifting. When something happens, a data release, an earnings surprise, a geopolitical event, or sometimes nothing obvious at all, institutions evaluate whether their current positioning matches what they should be holding. If a large number of institutions conclude simultaneously that they are overweight equities, they begin selling, not because the fundamental outlook changed dramatically, because their position is larger than they want it to be relative to their other holdings or relative to their risk tolerance. When a large number of institutions are all trying to sell at the same time, they hit the same bid. The bid moves down, prices fall. Volume increases. This is repositioning. And it explains market moves far more reliably than the news stories that get constructed afterward. The market didn't fall because earnings disappointed. Earnings disappointed and triggered repositioning. The repositioning is what moved the price. Sometimes there's good news and prices still fall because the good news triggered a repositioning away from equities. The narrative says it shouldn't happen. It happens constantly. Understanding this changes your relationship to market moves. A 3% decline is not necessarily a prediction of further declines. It's a day when a lot of people adjusted their positions. It could be followed by a recovery as new money comes in, as people who sold look for entry points as the initial selling exhausts itself. Or it could be followed by further declines. The daily moves don't tell you. But they're not about news as much as they're about position adjustments. The liquidity dimension nobody discusses. Here's another structural thing happening that doesn't appear in any headline. Modern markets are less liquid than they appear. The screen shows bid and ask prices. It looks like there's always someone willing to buy or sell at those prices. In normal conditions, there is, but the liquidity is not uniform. It's concentrated in certain assets, certain times, certain market conditions. When everyone wants to buy, there's plenty of liquidity. When everyone wants to sell, the liquidity disappears. A 3% market decline on what looks like normal volume can actually represent a meaningful shift in underlying liquidity. The selling was executed, prices moved, but the market absorbed the selling at different depths depending on the asset. Large cap stocks absorbed it easily. Small cap stocks might have seen 4 to 5% declines. Illiquid assets might have seen much larger declines or no trades at all if there were no buyers at any price. This is not discussed in news coverage because it's technical and not obvious, but it affects outcomes. It explains why the market can move meaningfully on days when the news is ambiguous. It explains why declines are sometimes sharper than fundamentals seem to warrant. Liquidity is like oxygen in the market. It's not noticed when it's present. But when it dries up, everything stops working the way it normally does. The algorithmic layer that amplifies moves. Here's something that's true but rarely mentioned. A significant and growing portion of market trading is executed by algorithms, automated systems that execute trades based on predetermined parameters. These algorithms are not stupid. Many are sophisticated, but they are not conscious. They execute their instructions regardless of context. If the instruction is sell if the price drops X%, they sell when the price drops X%. They don't consider whether that's a good idea. They execute. When markets move sharply in one direction, algorithmic systems across many firms may execute simultaneously. This amplifies the move. The move triggers more executions. This creates momentum that is at least partially independent of fundamental changes. This is not new, but it's gotten larger as algorithmic trading has scaled. Potentially 20 to 30% or more of market volume on any given day is algorithmic. In stressful markets, it can be higher. This layer of the market operates independently of news or fundamental conditions. It just follows its parameters. And when many algorithms have similar parameters, which they often do, because they're all responding to the same market conditions, and many are, built on similar logic, they can amplify normal market moves into larger ones. A 2% decline could become a 3 or 4% decline not because the fundamental news changed, but because algorithmic selling pushed it down and triggered more algorithmic selling. This is not a conspiracy. It's a structural feature of modern markets that amplifies both gains and losses. The positioning cycle that creates volatility patterns. Here's a structural pattern that explains a lot about how markets actually move. Institutions run on cycles. Quarterly earnings cycles, monthly rebalancing cycles, fiscal year-end cycles. These create predictable patterns of buying and selling pressure that are somewhat independent of news or fundamental conditions. At certain times in the calendar, there's systematic buying pressure. At other times, there's systematic selling pressure. This is just the texture of how large financial institutions operate. When this systematic positioning pressure aligns with market sentiment in one direction, volatility is lower. Institutions are buying while sentiment is bullish, so the buying meets demand easily and prices move up smoothly. When positioning pressure conflicts with sentiment, Volatility spikes. Institutions need to sell, but sentiment is fearful. So the selling hits weak bid and prices move sharply. Or institutions are trying to buy, but sentiment is bearish. So the buying has to pay up. The volatility you see is partly about fundamental uncertainty, partly about news, partly about positioning cycles creating buying or selling pressure at times when sentiment is either aligned or misaligned with that pressure. Understanding where you are in positioning cycles is more useful for predicting volatility than understanding the news. But positioning cycles don't get reported, news does. What this means for your actual decisions. If the market just fell 3% and you're wondering whether to panic, here's what you actually need to know. The move happened. The news media provided a narrative about why. The narrative is probably post hoc rationalization rather than actual causation. What probably actually happened? Some combination of repositioning, algorithmic reactions, liquidity constraints, and positioning cycle effects all moved prices. This doesn't tell you whether the decline will continue or whether it will reverse, but it tells you that the move is not necessarily an information event. It's partly just a repositioning event. Which means, if your thesis hasn't changed, there's no reason your positioning should change just because prices moved. Prices move for structural reasons that have nothing to do with whether the fundamental conditions for your investment are still intact. Panic selling on 3% declines is often selling because of structure, not because of information. Your ability to avoid panic selling on structural moves to distinguish between the market moved because people repositioned and the market moved because something fundamental changed is one of the highest value financial skills. The thing that's actually important. Here's what matters underneath all of this. Understanding market structure gives you resilience against narrative-driven panic. When you understand that markets can move sharply for reasons that have nothing to do with fundamentals, that liquidity can disappear in ways that amplify moves, that algorithms can trigger selling cascades, you become less vulnerable to the story the news is telling you and more confident in your actual analysis. You can say, the market moved 3%. The news media says it's because of interest rates. But I think interest rates were already priced in, and this move was more about positioning and algorithmic reaction. My thesis hasn't changed. I'm holding. Or, the market moved sharply but on actually low volume relative to the move. This suggests the move was amplified by structure rather than driven by genuine selling. I might even see it as a better buying opportunity than it appears. You can't predict markets, but you can understand them better than the narratives suggest. And that understanding is worth a lot when volatility arrives. The market dropped 3% last week. The news told you why. Interest rates, earnings, sentiment, geopolitics. All of it potentially relevant. All of it also incomplete. What actually just happened is more complicated. Repositioning, algorithmic reactions, liquidity constraints, positioning cycles, narrative construction. Multiple layers operating simultaneously, each contributing to the move in ways that are difficult to disentangle. You'll never have perfect clarity on what caused any specific move, but you can understand the structural layer that operates beneath the news layer, and that understanding changes how you respond. The next time you see a sharp market move and hear the narrative about why it happened, ask yourself, is this actually about news, or is this about structure? Because most of the time, when you dig beneath the story, you'll find that the structure was doing more of the work than the narrative suggests. And once you understand that, the panic becomes optional. Because you understand what you're actually looking at, not a warning about the future. Just a day when a lot of people repositioned.